Happy Tuesday. Good morning. Thank you for joining me. I know it's a little bit early, you guys, today, but I wanted to get an early start. Didn't want to disappoint our community or Trey. I'm going fishing later today. I'm super happy about it. Shark fishing. I need the balance. I've been working too much. Hopefully, you guys are doing the same. Hopefully, you guys have an outlet. But I'm excited to be here. The question is today, will rates hit 8%? Will mortgage rates hit 8%? Technically, they already hit 8%. And technically, some people are already getting 8%. But I'll say on average, will mortgage rates hit 8%? They absolutely will hit 8% if we continue to go along the path that we are with stagflation. So it is very possible that they hit 8%. And as a matter of fact, I think that they will. And then again, unless we have an economic collapse, they're not going to decrease interest rates substantially, maybe a quarter basis point here and there, which will mess up sentiment, to be honest with you. So to me, it's like hold until it breaks, right? Hold until it breaks. Let's keep going up until it breaks, because the reality is, as Americans, here's the thing. As an American on the sideline that wants to buy a house, what do I want? What do I want? Do I want to make 60% more money? Do I want values to go down 40%? Do I want interest rates to go to 2%? I'll tell you what I want. I want asset prices to come back down to balance, to back to the American level of sustainability. That's what I want. I don't care about anything else really except nominal price decline. Not even, I don't care about real price decline. Personally, I want nominal. I'm being real with you guys. And here's the issue, guys. With all of this data, it's really a tale of two tales. A tale of two tales, okay? You have the rich versus everyone else. And the rich right now are still buying like lunatics. And everyone else is like, oh my God, how are you guys still buying? So we have a tale of two tales. We have rich versus not rich. And when I say rich, I mean people that are purchasing $1 million houses. I can't afford $1 million house at a 7% rate. So there are still people buying. A lot of it is cash. And then we have real versus nominal. Real is the new kind of narrative that's being pushed, like the real prices of houses are going down, so it's okay to purchase. And real means adjusted for inflation. So if inflation is, say, let's say 10% and home value goes up nominally by 2%, the real growth there is -8. So real is adjusted for inflation. Nominal is what we all want to look at. And obviously, guys, there's a difference between new homes and existing homes. New homes, depending on your market. If you're in Jeff M's market, no. I've looked in his markets. I'm like, Jeff, you're wrong. I'm going to find you a house. This was, I don't know, Jeff, like a year and a half ago. And he was right. There's like no new construction there. So if you're in an area, especially like Texas, especially like Florida, and I'll show you here, inventory is blowing up. In fact, in Florida and in Texas, we have more existing inventory right now than pre-pandemic, statewide. Right now, in Texas and in Florida. I'll show you guys that. Very, very cool. Which brings me to the next thing. There's also a tale of two tales when it comes to Austin, right, versus San Diego. Austin is overwhelmed with new construction. San Diego's old money. The people have been there for a long time. They have a more established area. So it's a tale of two tales. But here's the thing, you guys. I'm going to tell you what matters most about all of the things that I just told you. What matters most is you. You have generally different goals, different markets than everyone else, and a different financial situation. So you really got to ask yourself, what is it that you want? What are you looking for? And the most important thing, how do you find it? Okay. And what I'm saying is what I prefer to do is put so much tools, so much empowerment in your hands where you can trust yourself. And you don't have to trust people and professionals that have lawsuits against them that they're continuously losing for conspiracy of commission. Because realtors do not treat consumers the way that they deserve to be treated. Okay, you're not going to ever change my mind about that, ever. I've been doing this way too long. So let's get right into this, guys. This is going to be a fast live because I have to get, oh my gosh, oh, this is crazy. You guys are going to freak out when you see this. But I have to be fast because I do have a fishing trip I have to get to. Take a look at this, guys. This is crazy. This just spiked right now. I was about to tell you guys like, oh, the 10 years flat, the 10 years flat, it may go down. But look at this, guys. It just skyrocketed upwards. Something came out right now. Not 100% what it is. It's a little bit early this morning, but it did go up. Look at that spike. I mean, the volatility in the bond markets, this is crazy. So keep your eyes on that. I'm not 100% sure what, I mean, something came out. Some type of inflationary data came out. Maybe Raymond knows. I'm not sure. Maybe you guys know. I'm not, let me see here. I'm not sure what came out. Something came out today. Look at that. It just came out like right now. Rates just are going to, they skyrocketed right now. Look at that. 4666. Y'all see that? That's the devil's number. That means don't buy. If anyone needed to sign, rewind this video. There's your sign, 4.666. That means don't buy. All right, let's keep going, guys. So 4.666, this is something that's ballooning there. Maybe we could do a little bit of research later to figure out what just happened. Of course, that happens as soon as I start the live. Right now, I wanted to show you guys where rates are at right now. Now, obviously, that's not pricing in a jump. This is Google. For some reason, Google has interest rates way higher. I don't know why. I don't know where they're getting their data. They're maybe pulling from advertisers. So my thought is they're pulling from advertisers, but they're pulling from somewhere. But either way, Google is saying the average 30-year fixed rate right now is 7.921%. If that's what you're getting, don't buy. If that's what you're getting, in my opinion, don't buy, because that means your credit's not good, your DTI is too high, because you should be getting 1% or more lower than this. Okay, so what I'm saying, especially if you're going to a broker, you guys should be able to get more like a 6.75. So a point to more. These rates. Okay, so personally, guys, I think this is garbage. That's why I never referenced Google, but that's mortgage rates. Again, I don't know where they're getting their data, but I like to go here, which is Mortgage News Daily. So you guys can see we've been kind of stuck here, middle 7% for I think it was a few weeks right now. This is very, very good. We want this. If you're out there shopping for a home, you don't want it. If you're on the sideline, you do want it. Why do we want this on the sideline? Because we want balance back to the housing market. We want a fair shake. We want to be able to afford a house without putting ourselves at risk. And I'm speaking for myself. Keep in mind, I don't mean to put words in your mouth, but you guys, 7.43 is going to stifle demand. We need demand stifled because we need inventory back, and we need that inventory sustained like we have in Florida and Texas. I'll show you that. But right now, 7.43%. A broker, I just closed the file. I interviewed my customer. First question was why couldn't you wait? Second question is, do realtors make too much money? Third question was what did you learn? So I have an interview for you guys. They were able to get a 6.5 by using a broker. Okay, so even these rates are a little bit high if you're listening to what I'm saying, which is increasing your purchasing, the power of your purchasing. Good credit is a great start. Obviously, income is very important as well. So 30-year fixed rate right here, 30-year FHA fixed rate is 6.92. That's finally above 15-year. You guys can see VA is just slightly higher a lot of times. You see that? Just a little slightly bit higher, which means generally 30-year fixed rate FHA mortgages are generally the lowest rate, even lower than ARMs. And look at this for a second. Look at the ARM. This is crazy. So the adjustable rate mortgage, this doesn't make sense. This is how broken the market becomes with exaggerated mortgage jumps. So the mortgage rates have been too volatile. The market can't keep up with what's called the pricing. Remember, I've been teaching you guys about pricing. That's why you see right here, the adjustable rate mortgage higher. Guys, it's higher than a fixed rate. Who in their right mind is going to take an interest rate, an adjustable rate mortgage that's higher than a fixed rate? What you see in front of you is a broken mortgage market. It cannot absorb those fluctuations. Okay, we've had massive fluctuations the last 2-3 weeks. You see that here. And that's what I keep telling you guys. When you lock your interest rate, you want to see like a broken market, because you can sometimes find windows. For example, Bank of America may say, oh, we want more business, so we're going to offer a rate that is under market. And that's kind of how you shop. But anyways, guys, let me keep going here, okay? Now, what you see here is you guys, okay, if you're a consumer, you want to know how all this works, just, again, this is all I did. I put mortgage payment calculator in Google. You guys play with this. Don't sit there, what's the word, naive, right? Don't sit there clueless, it's cool to rent, right? It's cool to do this. Never been a better time, but we have to be renting with a purpose. I'm telling you guys, I don't want Wall Street to own every single house. I don't want to be a nation of renters. I want to take back the housing market as consumers. It's just the greed, corruption, fraud, and Federal Reserve has made that almost impossible right now. But look at guys, okay, so here's your mortgage calculator. You always check include taxes and insurance. And all you got to do is you just put your home price right there. Okay, you can play with the down payment, right? So you want 5% down, that'll play with that. But my point is get educated. You can play with the interest rate, 7.25%. You can put property taxes. This ain't in Texas. If this was in Texas, property tax would be $7,500. Okay, you can play with your homeowner's insurance. This ain't Texas and Florida. If it was, it would be $2,500, right? And it automatically calculates your mortgage insurance, which is a complete waste of money. But it's here. Empower yourself. So look, it gives you your total monthly payment, and that includes your principal and interest, taxes, and insurance. This is a great way to empower yourself for free. You guys want to be ahead of the curve here and ahead of agents. Now, On top of that, I always want to make a point. Okay, if there's one thing I want to teach you guys other than subdivision analysis and how easy it is to manipulate credit, remember utilization ratio, amortization schedules. This is like the top of the top. I need you guys to understand it is so important that you do not ignore your amortization schedule and how expensive owning a house really is. You know, the bulls aren't talking about this. If you get a $324,000 loan at today's interest rate, you pay back $485,000 in interest. That's 150% in interest. You guys, if you pay this down slightly, about $18,000, you save over $110,000. But here's the point I wanted to make. Say you got your home. Say you're an existing homeowner and you watch me, okay? Get with your spouse and say, you know what? We learned how bad amortization schedule is. So let's decide how much money we can afford every month to put towards extra payments. And then you come to this amortization schedule and you click this magic button here that says optional make extra payments. So let me hit that and say, okay, you know, honey, we're struggling. Inflation's bad. We have children, blah, 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 blah. So we can only pay $125 extra a month, right? So say, which by the way, I feel like if I found a $100 bill on the ground, I don't even know if I'd be happy anymore. Inflation's so high, but $125 extra a month. Let's just see what a little bit extra does. Okay. So if you pay an extra $125 a month, you just turned your loan from listen guys, this is so important, man. $125. You went from a 30-year loan to a 25-year loan. Look at this. You save, guys, look at, this is so crazy. You save almost $100,000 if you pay $125 extra on your amortization schedule. Look at that. I'm going to highlight it. $93,425. Okay. For a little 120. That's how front loaded these are with interest. Don't forget that. All right. Don't ever forget that. I really want you guys to be great spenders, and I want you guys to be like warriors of amortization schedules. I want you guys to beat them down. Now, the question a lot of people are asking is, you know, when will the rates come down? And I told you guys when I did my video with Johnny, I don't know, I think you're online. I did a video with Johnny and Jason Walter, and I was like, man, rates are probably going to be real close to 8%. And they're not going to come down unless we have economic turmoil, which I believe we're going to have this year. Something, in my opinion, is going to break this year. But what is so intriguing to me is what the market keeps pricing in. They are sold now of like no rate cuts. There's probably going to be no rate cuts this year. And you can see the market shift, yet the stock market keeps going up. So I'm like, man, where did the fundamentals go? You don't think it's going to crash and collapse? Where's the fundamentals then? Where's the structure and sustainability? Is it just money? Is it just money printing? Is that the only fundamentals that we have? Inflation? Is that the fundamentals now? But anyways, guys, here's going all the way to the end of the year. So this is all the way to the end of the year. This is the highest I've seen this. They're saying, market's saying 18.7% chance, no rate cut. In fact, they're only now pricing in potentially 2 rate cuts. This is the 3rd rate cut, 10% chance. Isn't this just shocking to you how the market is always wrong? They're literally always wrong, and yet, you know, stock prices are still skyrocketing. I mean, how crazy is that, guys? How crazy is that? Anyways, so we're going to go into only one video. I'm going to try to do a quick market analysis today just to remind you guys like how easy it is to find a great deal if you have access to the data and you're out there like working your deals. So I hopefully will get, you know, to that, but I only have about 17 minutes. Let's go to our first video. You guys let me know if you can that the audio is okay. This is going to be on the 2%. Well, first of all, let me ask you guys this. Okay. Before I play this video, I want to ask you guys, this question. I'm just going to look into the camera. Do you guys really think it's possible that we hit a 2% inflation target absent deflation? So again, I'm asking, is it even possible that we hit a 2% inflation target without a collapse, without deflation? Because again, remember the deficit spending is out of control. I mean, is it even possible? I mean, seriously, think about it. I don't think it's possible. Anyways, if you guys can, let me know the audio is okay.
Jump in here. It says in my notes, stocks are likely selling off because of the inflation element of the GDP report. Certainly smelled of stagflation with weaker growth and hotter inflation. That's exactly the opposite, it seems to me, of what Greg is saying.
Yeah, and I think Greg makes a great point. There is a twist to the story around stagflation. In addition to what Greg mentioned, I'd also point to initial jobless claims this morning coming in at 207,000. We look at an unemployment rate that remains below 4% today. So the labor market's incredibly strong right now. I think the markets are really spooked by this idea that it's taking a long time to get back down to the Fed's 2% inflation target here. From a market perspective, we are seeing a potential rotation play out right now into more cyclical areas of the market, energy stocks, value stocks that really were not caught up in that Fed pivot momentum trade that resulted in massive multiple expansion, particularly on the technology side. So I think investors should consider leaning into those areas of the market because it does look like we're in a period where the path to inflation here is pretty bumpy in terms of getting it back down.
Is the market, Emily, overreacting to these numbers?
Potentially, first of all, when you get GDP reports, they don't usually move markets this much. It's a month-old report. It's heavily subject to revisions, and we'll find out what those are later. But I think markets are ultra sensitive to the inflation backdrop today. So as the day's gone on, and economists, great economists like Greg and others have really dug into the numbers, it turns out that growth really isn't all that bad. I think the challenge now is how the market's going to digest this new environment where cuts are being taken out. And that's really the challenge as bonds go up, yields, stocks fall, those correlations increase. Where are investors to turn in this difficult macro backdrop?
So Steve, tie this all up for us. If you would make a little bit of a reference to consumer spending, 2.5%, which was slower than previous quarter.
Yeah.
But also the idea of where this puts the Fed, because on the one hand, you have a maybe slower than anticipated economy, which would argue for maybe more a stimulative approach on the part of the Fed. And on the other hand, you have potentially, though Greg kind of disputes this a bit, a potentially higher inflation number, which would say you got to stay higher for longer.
Yeah. So, Tyler, I brought along a chart. Guys in the back, we have a chart on real domestic final purchases that should sort of ease concerns about the growth number. What this number does is it takes out, there it is. Now, it's really hard to see in that right-hand most number bar there a dramatic slowing of the economy. What you see there is an easing really from 2 quarters before it that were the hot numbers that were much more than expected. This, without those 2 hot numbers, would be a pretty good result. So I think you look at that, and that should ease your concern. That looks at the core of the economy, the business spending side and the consumer spending side. They're okay. And in fact, I would not be surprised or displeased to see them cool even a little bit more to get down and relieve some inflationary pressure that could potentially happen in the economy. As for the Fed, very quickly, I think the story is that they're going to wait and watch this. They're going to be very interested in how these numbers, as Greg said, parse out tomorrow. Do we have a January, February inflation problem, or is this also a March problem? That's something the Fed's going to want to see. But I think right now they're pretty firmly dug in with this idea that they have the right rate to bring inflation down, which means I don't think they feel as a committee they need to go higher here. So what this means is higher for longer. And it means that rate cuts are probably into the fall at this point. There's still a July possibility if we get some really good numbers. And Greg is right that we really had a lot of noise at the beginning of the year. But I would say that's a shrinking possibility. It's higher for longer. It's later rate cuts. But I think cuts are still a possibility here if what we're seeing is a lot of noise at the beginning of the year.
Greg, I'm going to give you the last word.
Yeah, I think Steve is absolutely right. We have to look at the underlying pace of growth. That still shows a relatively robust economy. Emily pointed out the fact that the labor market is the key pillar of economic activity. That's still sustained, but we are seeing evidence that we're still moving in the right direction in terms of disinflation. Policymakers will be much more cautious than we are as economists because they're working on a data-dependent policy play-by-play type of approach, which is a risky proposition in this environment. But they are likely to err on the side of caution and delay rate cuts until they are very sure that inflation is not about to reaccelerate. I don't think it will, but Fed policymakers will likely want to be a little bit
great.
more cautious.
And
what about the deficit spending? You guys know what I'm talking about? Like, what about the deficit spending? Do y'all think we can hit? Well, I saw a couple comments that we can hit 2%. I'm going to throw this up here real quick, and I want to get started on the real estate part of this. Really appreciate you, Jose Roscoe. Hi, Travis, new subscriber here. That abandoned Austin site that you visited a few blocks from me. Do you think the failed builder will fire sell? So I'm going to tell you this, Jose. You see that sign behind me right there? You see that over here? You see that sign right there? That's their sign. I found it outside of the subdivision. It says sold. I don't think they were selling on the sidewalk. So if you find them, Jose, I can't find them. I've called them. Let me know because I have their sign and I'm trying to give it back. Every phone number I found is disconnected. So the crazy thing though, I'll tell you this. I thought the same thing as you. I'm like, why aren't they selling this? Right? Because those houses were about 70% completed. There was granite countertops or it was like a quartz countertop. The cabinets were in the kitchen. Half those houses were painted inside. And so like, what happened there? Now it's full of mold and mildew. And so I walked up to the office. They still have an office there that's completely locked. There was no one there. And then they had a storage container. Oh, I don't know if I should say this. Let's just say they left there in a hurry. And I have no idea what happened and I've been looking. I have no idea. It's been absolutely crazy. All right. So, and I appreciate the support there, Jose. Definitely appreciate that. I mean, it was crazy. You guys got to go out there. I mean, Austin, he's there actually. Don't move to Texas right here. This is my man. He showed us. He took us there. This is my man right here. He was in that video. Definitely appreciate you. He's not wrong. Right? There was still copper wire in the houses, guys. There was still copper. That was what I was blown away, Raymond. How is there still copper? Anyways, let me show you guys now what's really, really exciting. I just did a video. I'm not sure when it's going to come out because I'm leaving today for just 2 days. Hopefully it'll come out this evening, but I don't think it will. Inventory. Everyone knows we've been waiting on inventory. And so now we have 2 states, entire states, depending on the metro area, of course, but we have 2 states that have more inventory than pre-pandemic. I'm going to show you guys right now. Okay. The first one's right here. This is housing inventory active unit count for Texas. And guys, here's the beautiful thing. Okay. This is existing. So here's the thing. We don't have the same demand that we did we don't have the same type of buyer that we did in 2019 because in 2019, savings rates were double, interest rates were half, and we peaked at real income growth. So we don't need as much, in my opinion, we don't need as much inventory as pre-pandemic. But that's certainly what we have already in Texas. You guys look at this. Okay, so here's where we're at right now in Texas. We're sitting at 89,639 active units. All right. Again, that's up from lockdowns. Here's where we're at lockdowns. We're barely above, but who cares? We finally got it in Texas. And so what do you guys think is going to happen? I think prices are going to continue to go down in Texas. Those are the only metro areas, according to Redfin's 4-week rolling average, that have been on the year-over-year price decline list. You guys, here's the most amazing thing. What if we looked at the same time period in 2019? So before the recession, right? So like March 2019, excuse me, I'm pretty sure we can all say it was basically a normal-ish housing market. So when we had a normal-ish housing market back in March of 2019, we only had, excuse me, in Texas, I'm so sorry, guys, 4,000 more units. That's it. Which means, why did I put a dollar sign there? We are 4,000 units away. That's it. But the thing is, guys, we have a more new home building going on right now than we did before lockdowns, which means if you're in Texas, depending on your metro area, we should now have more options to purchase homes than we did right before lockdowns. Obviously, it depends on the subdivisions and area, but isn't that insane? This is great. Let me show you guys one more thing, okay? That was Texas. Now, remember, Melody and I have a bet, and I'm like, oh, Texas is going to be worse. She's like, no, Florida's going to be worse. The trajectory, guys, of Florida is freaking nuts. Florida's crazy. All right, so here's active units for Florida. Just like Texas, okay, here's where we're at with units, active units. We are at where we were at pre-pandemic with active inventory in the entire state of Florida. So now what happens, right? The pressure prices to go down should accelerate because now we have almost as much inventory as when, again, pre-lockdowns. But Florida is a little bit different than Texas. So when we look right here, this is March of 2019. Okay, so March of 2019, we had 152K. Right now we have 131K, which means, what is that? 21K off. So they're 21K off as a state. from being back to March of 2019. That's why I'm saying, Melody, I think Texas is going to be worse than Florida. Because also remember, Texas also has they're further along with the STR bans, the short-term rental bans. So that's what I'm thinking there. Inventory is great. I just want to throw this up real quick, guys, and then I'm going to pull up the MLS because I want to show you what we should be looking at as consumers. Remember, to find a great deal is just simple math because the way value is calculated, okay? Remember, the way value is calculated, what you guys are looking at here is just an appraisal. This is just a normal appraisal, but I want to explain value is not calculated by price per square foot, and value is not calculated by median sales price. Value is generally it's always generally, because there's always special situations. It's generally calculated on what people are paying for in the subdivision. So what are houses selling for in the subdivision? It is so important, the subdivision. And so you need 3 comps. Basically, you need 3 comps for an appraisal. You see that here? This is one comp right here. You guys see the second comp and you see the third comp, okay? Right here, again, there's your second comp, there's your third comp, and each of those comps is compared to the subject property. And this column right here, that's our subject property column. And all of those characteristics you guys see here, so that's characteristics there, square footage, blah, 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 is measured against these 3 comps, and then a net value is assigned. Okay, you add all those together. Essentially, you divide by 3. Basically, that's not really how it works, but that's kind of how it works. And then you get your appraisal value. So the reason I'm telling you that is because it's just simple math, right? I always want you to understand all of this is simple math. All right, now let me switch to, how do I want to do this? I'm gonna do it like this. Okay, that didn't go as well. Okay, now here's what I want you guys to know. Okay, remember, when it comes to analyzing, all you need is access to the MLS. Some states are public states, and you can access stuff like through Zillow. Other states, like what I live in here in Texas, are non-disclosure states, so you can't use Zillow. But ultimately, this is what you guys need to do. You need to figure out what so whatever property you want, you got to review the subdivision. It will list the subdivision. See, right here it says Kings Manor. So the only thing I care about is looking at comparable sales. And I have to go, dang it, I don't have time for I don't have time to do a full market analysis, but I would be reviewing this subdivision right here, and I would look at the comps for the last 3 years, okay? Unfortunately, I can't do that right now because of time, and I also wanted to show you something cool, okay? I wanted to remind you guys, on Zillow, remember you guys, on Zillow, they have a whole section of foosbos, and this is what it looks like. Look how many foosbos is a for sale by owner. So generally, you got to be careful. Raymond is going through a situation that's a foosbo, and there are disadvantages, like you can run into some traps and things like that, and there's no agents involved. So it could be a good thing because it's cheaper, but it could be a bad thing because of the experience of the parties. So it's just, you just got to be careful is my point. But look at all that. So these are all the people that either they don't want to pay their realtor, either they can't afford to, or they just don't like realtors and they want to try to do it themselves. But again, if you really kind of want to just see what's going on, not everything is on MLS. There is data you guys can access. You don't necessarily need it. But I thought that was interesting. So there's a decent amount of foosbos in Houston, over 100. Now, likewise, you guys, you can also do the same thing with foreclosures. So you go to buy here and you just drop down foreclosures, put wherever you want, and look at that. So in the entire state of Texas, this is just look at, oh my gosh, that's crazy. So there's about, 1,800 foreclosures in Texas right now. And if the housing market was super piping hot, then there would be no foreclosures because they would just sell and someone would immediately purchase it. But like I said, Texas has more inventory now than pre-pandemic, as does Florida. And so this stuff is going to sit here and rot until the prices go down. But that's a decent amount of foreclosures, you guys. Again, these are all foreclosures. So play with the data. If you're feeling frustrated or whatever, come over here. And I'm going to show you one other thing. Take a look at this. This is HUD. I don't know if you guys remembered this or not, but HUD has foreclosed houses as well. So again, because Zillow doesn't have everything, you guys can go to HUD. This is HUDhomestore.gov. So if you guys want to go, again, HUDhomestore.gov, and this is a list of houses. So just, again, bids open, May 1st. It's not the easiest thing to get a HUD house, but it's definitely an option to get it. I don't like the process. I think dealing with HUD is an absolute nightmare. But I mean, they got some of these prices are reduced enough to where there is there's ample wedge. So just trying to give you guys resources. Again, hudstore.gov. This is where they actually own these houses already, and they are trying to sell it in the market. But again, this is just HUD owned. Okay, so probably an FHA mortgage or something like that. Now, let me just get us out of here, you guys. I have about 2 minutes left. I wanted to show you real quick, let's just some economic indicators, and then we'll get out of here. And I love you guys. I really do. I really appreciate you guys. Look at this crap right here. Okay, so what you're looking at here is called stagflation. I'm just kidding. It's called the 10-year treasury constant maturity minus the 2-year treasury. But I'm just saying stagflation because we've been inverted for like the longest time in history, which makes sense because of the amount of inflation. We're like stuck. Like we can't get off 30 basis point inversion. Do you guys notice that? We're stuck on 30 basis. It's like everyone's waiting for what's going to happen next, right? But I'm telling people, we know what's going to happen next because you guys are still spending as if there's nothing going to happen next. You guys are spending like they're going to bail you out. I see that from Vital Signs all the time. I wish Vital Signs would come back. I miss that guy a lot. I see him on Twitter. He is roasting these bears. He is roasting these real estate bears. I follow 19 people on X Twitter. Vital Signs is one of them. I think that guy's hilarious. And I take it to heart everything he's saying, by the way, to make sure that I stay sharp. And I don't want to be stuck in the narrative either. But you guys, we're stuck. We are stuck. We are going to stay here until something breaks. 30 basis points. We can't move off of that. Look at it. We've been stuck since October. So a half a year. I want you guys to think about that. We have been sideways for a half a year. Everyone's waiting for what's going to happen. But yet, you know who's not waiting? The government deficit spending. That is just skyrocketing. So even though everything's, why do you think it's pausing? Do you think it's the overwhelming deficit spending and the money just raining into our economy? That's probably what it is. Take a look at this. This is also insane. The reverse repo market. This is part of the reason why we have this runaway inflation, because this buffer will not go away. Look at guys, it went up again. This is freaking nuts. I was thinking next month, which is May, I was thinking by the end of May, this money would be gone because I studied the trajectory. But right now, we're stuck. We're stuck. We've been stuck since February at 500 billion. This is crazy, you guys. We have an inflation problem. I mean, we already knew we had an inflation problem. I'm just showing you the data that's saying that we have an inflation problem. I mean, it is what it is. And I'm going to get out of here, you guys. I'm running a little bit late, but I didn't want to disappoint you. I woke up, I'm like, I just got to go. I just want to have peace of mind. I want balance. I just want to go and fish. I've been working for like 3-4 months straight, but I was like, nah, I'm going to do a live. I'm just going to do it earlier because I love my man, Trey. I don't even see Trey on here. But I was like, you know what? But I look at Trey as my the community of real estate mindset. I didn't want to leave you guys hanging. Just wanted to give you guys a little bit of data. I mean, things are absolutely wacko right now. You guys join the Discord. Obviously, I mean, there's a few hundred people in Discord. We have good times. We have bad times. But each of us is sharing data and trying to help each other out. So I appreciate you. I love you guys. I should be back on Friday. Wish me luck out there shark fishing. You guys, last time I went, I broke my ribs. Oh my gosh. And that's why I've gained so much weight. Like I can't work out with broken ribs and a rolled ankle. Anyways, guys, I appreciate you, everyone for joining. Les, your job is not work. I mean, brother, I've done 1,000 videos. It's work now, man. I don't know how else to say it. I mean, I hear you though. I appreciate every single one of you. Again, thank you for the support. Cindy, I see you. There's Charles. Charles, always nice to see you. There's Christy, just everyone, just Dean. He's in he's in our Discord. Don't see my man, Trey. It's all right. All right, guys. There's Living in Omaha. Where you been? Living in Omaha? Where you been, man? Anyways, guys, make sure you appreciate you guys like the video. There's my man Raymond again. All right, guys, I'm going to get out of here. Now, if you're out there investing in real estate, you guys already know that I appreciate you. You guys already know that I'm worried about you. You guys already know that I want you to make great decisions. And you guys already know that I hope you win.